3, 2, 1.
All right.
Check out our nifty new sign.
Like that? It's kind of like that.
Glowing green in here.
I think we should change the name to the Weekly TSP Happy Hour. Isn't it? It looks like it should be a happy hour sign, yeah?
We're in a nice
little
cozy
martini glass right there.
Yeah. Every time we do that, YouTube.
Yeah, they don't like that.
I don't like it.
Fox used to have a thing like that.
This is just water.
Fox Business used to have I don't know if it was like every Friday or every night. I can't remember, but they had a happy hour segment. They would sit around a bar somewhere in New York and talk about the market that week, kind of like what we're doing.
I think ours is more successful.
Theirs ended at some point, so yeah.
Ours is never ending.
Yeah. All right. It was a big week.
Yeah, man.
It just keeps going, and it obviously takes us some time to put these slide decks together, and by the time I get done putting the slide deck together, there's more stuff to talk about that I want to add into it, but we got plenty on this one. We got a whole bunch of different things to talk about, so let's get busy. So, TSP Weekly Podcast, 26 March, 2023. So we're going to look at the market this week. Basically, I got a list of like the key things that happened on each day, because there were a whole lot of things that happened every day this week that affected the volatility, within the week, but are ultimately going to affect things long term. The biggest one was the Fed announcement on Wednesday. We're going to talk about that and the market's reaction. And last Saturday, I spent the whole day it was online, but it was a WealthyOn conference. We talk about WealthyOn all the time. And I'm going to just kind of give you guys the highlights of that conference and the speakers that were there. It was a long day, but a lot of really interesting stuff. Then we're going to look at the C fund versus the F fund as a bonus chart. A lot of talk about the F fund right now, and I'm actually going to do kind of a special market update special. I don't know what I'm going to call it, but something like that. And I'm in the middle of doing it right now.
Is this something you're going to put out separately?
Separate, and it's going to be a subscriber product basically, and it's going to be
for our members.
Yeah.
So if you're a member, be watching.
If you're a member, be looking for it. It'll be in your email sometime next week. There's a lot to talk about there. The F fund is essentially almost like the S&P 500 of bonds. It's the main metric that the bond market uses to measure itself against. But within the bond universe is long-term debt and short-term debt, and they do not move together.
Right.
And so there's a lot of stuff to talk about, and whether or not the F fund is going to participate on the upside if the stock market tanks depends on what happens within the F fund, which tracks the aggregate bond index, which is the aggregate, right? It's not just long-term bonds. Yeah. It's not just treasuries. It's also corporates. So there's a lot of stuff in there to talk about to really drill down to figure out how and whether or not the F fund is going to participate in a rally if the stocks tank. So definitely be on the lookout for that. And then, of course, we'll finish with the weekly fund charts. All right. So what happened this week? If we go back all the way back to Monday, Monday morning futures were really low based on, continued fear of banks, and that kind of played out throughout the week. We had continuous bank failures throughout the week. But not a whole lot, because everybody is kind of on the edge of their seat waiting for the Fed to FOMC meeting, which was Tuesday and Wednesday. So the market recovered a little bit on Monday. It was basically flat. Tuesday, FOMC meetings begin. Market was rallying, right? Rallying into the Fed meeting, and all the major indexes are above their 200-day moving average lines. So the S&P 500, the NASDAQ, and the Dow Jones Industrial Average all finished the day above their 200-day moving average lines, which, they're all moving higher. Then on Wednesday, Christine Lagarde, who's the president of the European Central Bank, says there's no indication, at least in Europe, right, of inflation slowing down. The Fed comes out and raises 25 basis points, which we all expected. At the same time, the Fed is doing its press conference. Treasury Secretary Yellen is testifying in front of Congress, and she, to one of the questions, she says that, no, we are not going to backstop all bank deposits. It's going to be on a case-by-case basis. So, no, all bank deposits are not insured. And that is what ultimately had the market roll over. Intervention is going to be on a case-by-case basis, and that's still playing out to this day. Thursday, Bank of England hikes 25 basis points. A 2% rally in the S&P 500 intraday, by the end of the day, gets reduced to only 0.3% by the close. And then Friday, we're recording this here at about noon, about 1 o'clock. Friday morning, Deutsche Bank crashes, right? Yet another in this series of ongoing, bank crisis around the world, which makes sense because all the central banks around the world are raising interest rates, and they have been for the past year. So it shouldn't be a big surprise that banks around the world are crashing. Huge weekly inflow into money markets and out of banks, because that's been the talk of Bloomberg all week. Everybody is worried about the security of their money in banks, and that you can get a much better rate of return just putting it in a money market account. So it was a big week, and this weekend's going to be interesting because all the talk on Bloomberg is about whether or not those guys actually get a break this weekend. Because if this banking crisis continues, there's just no way to know which way it goes next. And it's not just banks; it's everything that's interest rate related, at risk because of higher interest rates. Okay. So the Fed announcement was really the key of the week, but there was so much other stuff. So on Wednesday, the Fed raises 25 basis points, which is what we expected was going to happen. The more important kind of takeaway, because it wasn't really expected, this was in the statement. So it wasn't in the press conference. It was part of the official statement from the FOMC. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to a 2% over time. So that was a change from, I can't remember the exact wording, but it's a little bit looser than what the Fed had been saying, that they expect more tightening to be necessary, right? So they've been saying more tightening is going to be necessary for at least 6 or 8 months. And they had been using the same language. And then this meeting, they come out and they change the language a little bit, and they say some additional policy firming may be appropriate, right? So the market took that to be dovish, and that any minute now the Fed's going to pivot, right? So that was the idea. But the language says more firming may be appropriate. I mean, he's telling the market that it's data dependent, and he could still raise rates, but the market kind of took that the other way. And then at the same time, Yellen's testimony to Congress, and here's what it looked like. Okay. XLF is the financial sector ETF, and the market had gone up on that kind of dovish statement in the FOMC statement itself. So they had that. It was kind of a pre-read. So they had that. So the market took that as meaning that the Fed is likely to pause going forward. But then when Yellen came out and said that all the deposits are not insured, it's going to be a case-by-case basis based on whether or not the bank that they're looking at is too big to fail. That's when the market tanked. So a really interesting day on Wednesday. Any thoughts about that before we completely shift gears?
No, I mean, you and I have been talking about it all week.
Yeah.
I mean, there's a lot of things buried in there we could probably talk about for the next 30 minutes. But I think, at this point, I think most people are just tired of hearing about it because it can get confusing. I mean, I think you pointed out, you were watching something on CNN that completely misinterpreted something that was put out. I'm just using that as an example, but it's like I see that all the time, right? It's why I don't watch mainstream media, not for all the divisive reasons that most people are talking about, but it's just, I worked in media for a while when I was in the government, lucky enough, I guess, or unlucky enough. But I always saw this where, like, you get competing narratives and you get people just kind of running with what they know, and they're not really putting a lot of thought into it. And they're just trying to fill time. And so I get exhausted by that. So I try not to consume my information that way. Yeah. I try to get it from people that have thought about it for more than about 30 minutes.
Yeah.
Which is tough because that means you got to let it play out too. And I think you might have just mentioned this a second ago, like the actual like written statement that came out from the Fed, is a little different than kind of like the words that came out of his mouth. Well, that's just human nature, right? That's going to happen. I mean, they didn't write that in 30 seconds. They thought about it. It went through probably lots of people. And then this poor guy, I feel for anybody that's got to get up and then like convey a message this important and not screw it up.
Yeah.
So anyway, I think all things considered, they did what we thought they were going to do, which was nice. I really wasn't in favor of a pause because I thought it was going to cause more chaos.
Yeah.
And not that I want interest rates to keep going up, but, at some point, we got to see if this is going to work. Like, you got to let their plan play out. Yeah. This is the way of the world. Inflation happens. Recession happens. This isn't the first time. And so let's see. I don't know. Yeah. We got to let it play out because if we keep second guessing everything, well, then nothing ever really finishes its process.
Right. That was one of the
pausing is just going to make it linger.
Yeah, that was one of the most interesting things yesterday in Bloomberg. They interviewed a bunch of different people, and they kept asking this question. Everybody knows, and it's seemingly a foregone conclusion, but the foregone conclusion is that we're going to get a recession here, and it's going to be sooner based on this banking crisis. But recessions don't usually happen when everybody knows it's coming. And
that's odd. But, I think, like I was talking to you about, I think it was yesterday or the day before, the difference is when we've had recessions in the past is we didn't have access to the amount of information we have now, right?
The immediacy of the information.
Yeah, if you go pre-internet, the only way you got this information was a newspaper, a television, or a radio. That's it. Yeah. And so maybe you didn't even follow those, right? Because a lot of people didn't, right? And as you get older, normally you would watch more news and less sitcoms. And like that whole thing played out for probably close to 100 years.
Sure.
Of television, radio, and news. And papers, right? And so then all of a sudden the internet comes along and I have access to it, not just 24/7, but 360 degrees.
Yeah.
I'm getting it from everywhere. Yeah. And so now what you have is enough people talking, enough chatter that, we wouldn't know a recession's coming till it was already there or on its way to be done. Yeah. You wouldn't have felt it until it happened. And then once it rattled you, you're like, oh, let me find out what's going on. And then I pay attention to the news and you go, oh, we're in a recession. And that's what used to happen. And that doesn't happen now.
It is still happening. Because if we talk about this all the time, right? I'm in the middle of this all day, every day. But then I leave and go to lunch.
But if you're not watching, if you're not dialed into this stuff, people aren't knowing it. They're like, we're in a recession. We're going. Right. What are you talking about?
Right.
Yeah. I mean, yeah, you're right. Like we tend to think everybody thinks like we do, as a lot of people do. That you're into something. Yeah. Like if you're really big into motorsports and you're talking to somebody who has no idea what you're talking about, you're like, oh. Okay, right. You don't know what I'm talking about. Right. And so we tend to be a little bit more tuned in the financial industry. But, at the end of the day, like what we hope you guys, the viewers, the watchers of this are getting is that, how this stuff impacts your TSP. And that's the biggest takeaway. And, outside of that, at least in this forum, we're not really concerned with it, right? We're like, are we as people? Yes, actually, we're investors. But at the end of the day, like, what does it mean for the 4 TSP funds?
Right. So the interesting thing about what does it mean for the TSP funds with respect to what we were just talking about, the fact that the information happens second to second, right? What they were talking about on Bloomberg was this idea that since everybody knows the recession's coming, the market is already pricing in what's going to happen after the recession comes, right? And
right. They're getting ahead of the game. You're right.
Yeah.
We talked about that too. Like
right.
you're messing up the algorithm, man.
You have if you are basing your trading on, okay, I got it, the recession's going, but I know that it's only going to last 18 months because that's the average.
Yeah, you're making a lot of assumptions.
And then you're going to preset your investments based on that. But we haven't had the recession yet, and with the recession comes a big tank in stock prices.
And you don't know how much of a recession. You don't know. We talk about soft landing, or we don't talk about it as much as like the news does. But what does that really look like? And anyway, like this is why I was being quiet, because we could talk about it for the next 30 minutes.
Yeah.
Because it's just such a big topic, and it's so important, but it's also. Again, this to me, it falls in the category of I only worry about things I can control. Yeah. And this certainly is not something I can control, but we just need to be informed. And I think that's the takeaway. Like the only thing that happened the other day, the only real thing that happened was we went up, a
quarter point,
yep. And the market tanked based on fear, right? Which is no different than if you go backwards the last years. I mean,
forever. Yep.
It's fear and greed, and it's monetary policy. Like nothing else other than that really happened, right? A few more banks are coming out, but that's okay. Like nothing really happened other than that, and we kind of knew all that was going to happen.
Yeah. So the thing is, like, so if you're watching the stock market and you're going, there's no problem. It's not really going down. It's not crashing or anything like that. And you're saying, okay, it's not crashing because these guys are looking past the recession that hasn't happened yet. If you don't know that piece of it, you don't really know to expect that your TSP funds are going to go down before they go up. We haven't had the recession yet.
Right.
I say it's definitely coming because it virtually has to be based essentially physics. Yeah. On the other hand, when everybody knows it's coming, it doesn't. So I mean, who knows?
Yeah, and we're just going to respond to what it does.
Right.
That's the biggest takeaway if you're watching this is our philosophy is we're not going to try to guess. Like we'll sit here and talk about it because it's fun to talk about for us. But at the end of the day, we're only going to respond to what has happened. We're not going to try to guess what happens.
Yeah. No. Okay. Totally switching gears. So, a really, really good WealthyOn conference. If you guys don't know what WealthyOn is, go to YouTube, search WealthyOn. They tend to have kind of more bearish people on there. Every once in a while, they throw in somebody that says the market's going to go much higher. There aren't many people that think the market's going much higher from here. So, I don't think WealthyOn over time is going to be a particularly bearish YouTube channel, but right now it certainly is. But if you want to get the highlights, basically, WealthyOn put out this YouTube link to like the highlights of the conference. It was like a 12-hour conference. Definitely check out that link. It'll give you the highlights with the videos of the actual speakers. But here's kind of my takeaways from it. So the first speaker they had, his name is Lacey Hunt. He's a former economist at the Fed. He's executive vice president of Hoisington Investment Management Company, vice chairman of Hoisington Strategic Investment Policy Committee, and also chief economist at Wasatch Hoising Treasury Bond Fund. So he focused on M2, which is the flow of money in the big scheme of things, how money flows. M2 is collapsing, which ultimately is deflationary. And so based on that, he's saying that inflation is almost resolved, right? It's peaked, it's coming back down, and ultimately deflation is going to be much more challenging for the Fed. Even though we're all focused on inflation, at some point prices are going to start coming down, and we won't be talking about disinflation. We'll be talking about deflation. He thinks Treasury yields have peaked. Overall, he's very bearish on pretty much everything. Mark Faber was the next guest. He's a Swiss investor based in Thailand. He's the publisher of the Gloom, Boom, and Doom Report newsletter. He's the director of Mark Faber Ltd. And acts as an investment advisor and fund manager. Really funny guy. he thinks the Fed will rescue Wall Street at the expense of Main Street. That's one of the big questions right now is, does the Fed cut rates to rescue Wall Street, or do they keep raising rates to bring down inflation? If they pivot, the idea is that inflation goes through the roof, but it rescues the stock market to the expense of the rest of us because inflation goes so high. So he's saying that the 40-year downtrend in yield has bottomed. So that's one of the things we're going to be looking at on the newsletter this weekend. From the top in the early 1980s, when Paul Volcker pushed inflation or interest rates up to like 15%, to get rid of inflation back then, that was the top in yield. Since then, yields have been coming down, and he thinks it's bottomed. Long-term uptrend in yields and rates. So because yields have bottomed, we have turned the corner now in 2020, which was the bottom in yields, and now he thinks we're in a long-term uptrend in yields. So yields and rates is the same thing. He thinks rates go much higher, potentially higher than 15%, which is what it was back, in the early 80s. His overall come from right now is the idea is not to look to build wealth. This isn't a time, like from 2009 to the top in 22 where everybody's looking to make money. From his perspective, now is not the time to look to build wealth. It's the time to try not to lose wealth relative to inflation, because inflation eats into whatever you do have. So overall, he also was bearish. Mike Pinto, he's always really good on there. President and founder of Pinto Portfolio Strategies. It's an RIA firm, provides money management services and research for individual institutional clients. He's a regular guest on CNBC, Bloomberg, Fox News, and all the other financial media outlets. Currently, he is in treasuries. He's long the dollar. He thinks the dollar is going to go higher, and physical gold. He thinks the next move, or his next move, is going to be in increasing short positions in stocks and adding to long bonds. So TLT and ZROS, we've talked about that before. Long-term treasuries is TLT, and zero coupon bonds is ZROS. And he's shorting the stock market, so because he thinks things are going to get worse. Fed will pivot. Fed pivot will cause double-digit inflation. So he's on the same kind of team with Mark Faber about that. Recession/depression to start sometime in 2023. Overall, he's also very bearish. Danielle DiMartino Booth. She's the founder of Money Strong LLC, which is an economic consulting firm. She began her career in New York at Donaldson, Lufkin, and Jenrette, and then she worked at Credit Suisse, where she did fixed income and the public and private equity markets after working as a financial columnist at the Dallas Morning News. And then she spent 9 years as an advisor to Richard Fisher at the Federal Reserve Bank of Dallas. So Danielle thinks that commercial real estate and associated banks are the next shoe to drop. And there's a lot of talk in the last couple of days really about commercial real estate as being seriously the next shoe to drop, which is going to affect banks continually. High risk of a credit bust, which credit is what makes the world go round. So everybody talks about liquidity. There's a big liquidity problem out there. And from her perspective, pretty much like everybody else, the Fed has two options. Either you save the stock market by bringing rates back down to, they call it ZIRP, zero interest rate policy. That would cause hyperinflation or higher rates for longer, right? Which is what the Fed has said it's going to do. But higher rates for longer will not rescue the stock market, so the market tanks and puts us into this massive recession/depression. So you can kind of get a flavor for those four. They're all kind of on the same team. They're all bearish, and it really depends on whether or not the Fed bails out the market or continues to be focused on inflation. Okay. Stephanie Pomboy founded macro mavens in 2002. Firm delivers insights on emerging macroeconomic trends and their implications for global financial markets. Prior to Macro Mavens, she spent the prior decade working for Ed Hyman and C.J. Lawrence and ISI Group. She thinks the Fed has already hiked too much. Everything works on a lag, and she thinks that the Fed has already broken something, which was Silicon Valley Bank. It's the beginning of what a lot of people have been talking about, a credit crash, things breaking in the economy that ultimately require the Fed to pivot. She's looking for a dramatic slowdown in consumer inflation, which would be great for the Fed. That's what it wants. Shelter, right? Housing is what's holding up the CPI, but it's a lagging indicator. Right now, she is short high yield growth, and she's saying own physical gold. Michael Leibowitz, over 25 years of financial markets and risk management experience, currently at RIA Investors with Lance Roberts, and those guys are both on WealthyOn every weekend. They're the ones that do the weekly summary. Throughout his career, Michael's been involved in trading, portfolio construction, and risk management, involving some of the largest, most active portfolios in the world. In addition to broad institutional experience, he also built a successful independent RIA, which allowed him to further extend his experience into the realm of investment management for individuals and family offices. He's on WealthyOn quite a bit. He thinks inflation, as opposed to Stephanie, who thinks inflation has already peaked, he thinks inflation is problem number 1, 2, and 3. Debt-based economy, we have a debt-based economy, right? So raising rates really hurts, but it has a lagging effect. Silicon Valley Bank is one example of the effects of raising rates too fast. And he thinks ultimately, because the rates came up so fast, they're going to go down really fast. His perspective, like most of the others, is to own TLT, which is long-term government bonds. UUP is the dollar index, so he thinks the dollar is going to get stronger because the recession that hits Europe is likely to be much worse than the recession that hits the U.S. So on a relative basis, it's better to be in the dollar than to be in euros. Nick Gurley established Reventure Consulting and its suite of solutions. So he basically, this company was born of a dual passion. Reventure Consulting helps clients connect the dots between urban economics and real estate development. Data provided by Reventure Consultants allows real estate professionals to confidently pursue investments in the right locations. He's a real estate expert, had a really interesting kind of conversation in there. The bottom line is he thinks we're in the very early stages of a housing crash. Of course, housing is regional, so Florida and New England have been holding up the best, but he expects them to roll over. And he thinks that this is going to be basically a 3 to 4 year housing decline. So if you're thinking about buying a house, from his perspective, somewhere around 3 to 4 years out is where you're going to get your best price for houses. Doomberg, pretty interesting. Doomberg is I don't know if it's a bird or a chicken, but if you go to their site or look at it on YouTube, he has some kind of an like a cartoon bird or chicken or whatever that acts as the person. But so they started Doomberg in May of 2021 to highlight the fundamentals missing from many economic and policy decisions, and quickly grew to be one of the most widely read financial newsletters on Substack. Publication is their passion, and the content is born out of the team's deep experience in heavy industry, private equity, and the hard sciences. Family offices and C-suite executives hire us to deliver innovative thinking and clarity to complex problems. We operate as though our subscribers share those same expectations. So Doomberg, they kind of focus on hard assets. They think that UNG is U.S. natural gas and oil are currently down because we had unusually warm winters in the U.S. and in Europe. But in the big scheme of things, they are bullish those commodities, so oil and natural gas. A lot of that is based on China demand, because China, of course, just came out of a very long extended lockdown, much more extended than the rest of the world. So bullish natural gas, bullish coal, and they're also bullish the alternative energy sector, basically because the government is kind of really, I'll say, forced public investment. They're really incentivizing companies to invest in alternative energy sources. The guys at Doomberg don't really think that in the long run this is going to work, but in the short run, money's flowing into it, and so the stock prices in those companies are going to go up. All right, last slide of these guys. Rick I'm going to try and Rick Rule, highly experienced investor and speculator, focused on sub $1 billion market cap public and private issuers in natural resources industry. So he's a big commodities guy. Structured, led, and participated in hundreds of privately placed debt and equity issuances for resource companies operating internationally. Okay, so coming scarcity in key commodities due to underinvestment in infrastructure. So the U.S. and a lot of the rest of the world, because we are going towards alternative energy, there's no incentive for companies to drill new oil wells and open up new infrastructure for hard assets. So because of that, it creates scarcity, but there's still going to be a need for those kinds of commodities. So he thinks that based on that, as the macro indicators, he's very bullish hard assets, agriculture, precious metals. He's saying own physical gold, natural gas, base metals, copper is a huge one, but nickel, cobalt, platinum, uranium, all the things that go into making like lithium batteries and iPhones and all the rest of the stuff that we buy. Lucky Lopez, he's got a really cool YouTube channel. He discusses all things automotive and finance. He's basically finance for used cars. Car dealerships, rental cars, auto repair, body shops, how to flip cars, the whole automotive market, and credit. So it's all about finance in terms of the auto market. He thinks auto loan delinquencies and repos are going way up. Lots of risk to banks that hold auto paper. So kind of like in 2008, banks that held mortgage-backed securities, there was a lot of risk there. He's kind of equating the same kind of thing. So your local banks that have a bunch of loans that are trying to sell them up the chain are having a very hard time doing it because there's a lot of delinquencies now on auto loans. So he's, at the end of the day, he says if you're looking to buy a car, Q4 of this year will probably be likely a bottom. And so that's, if you're looking to buy a new car, Q4 of this year is probably the time to do it. And then the last one was kind of a summary of the whole thing, the whole conference that they did with the guys from New Harbor Financial and Lance Roberts from realinvestmentadvice.com. They think, we talked about a lot of different things, but at the end of the day, the biggest takeaway is bond market is extremely short-term overbought. So we had a big spike in the F fund, and they think that in the short term, it's overbought. So kind of have patience there. And he's saying the market wants to go higher, right? Everybody still has this buy the dip mentality. It wants to go higher. It just needs a reason. Certainly didn't get any reason this week to go higher. And he's saying you don't want to be in equities. This is kind of a long-term statement. You don't want to be in equities if the Fed cuts rates. You want to be buying equities when the Fed stops cutting rates, because they're cutting rates and they're going to be chasing the market down. When they stop cutting rates is where these guys are saying will be the bottom in stock prices. Okay. It was a big 12 hours last Saturday, and again, go to that YouTube link that I put on the first slide, because it gives you kind of a 30-minute summary of the whole 12 hours.
Yeah, and you can fast forward to the parts you might be interested in.
Yeah, it's good. It's it wasn't cheap to be on that conference, but it was a ton of really interesting information. Okay. All right, bonus chart, C fund versus the F fund. A lot of talk about the F fund, and we're going to kind of do the highlights and a couple of ideas here. So we're going back to the top in 2022, right? The bond. So this is the S&P 500 in candlesticks and the F fund in yellow. Okay. So the bond market had topped out back here somewhere. But at the top of the stock market in 2022, ever since then, the trend of the bond market and the stock market have been in the same direction, right? When stocks are going down, bonds are going down. Stocks are going up, bonds are going up, right? And that's why the 60-40 portfolio didn't work last year, because the idea ordinarily is that when stocks are going down, bonds are flat to up, which kind of takes the sting away from the stock market going down. And then on the reverse, when the stocks are going up, the bonds are flat to down. So you lose a little bit of the gain in the stock market. But overall, that's why people use the 60-40 portfolio. But since the top in 22, they've been going up and down together. So the idea is that at some point, the stock market tanks and investors flee to the safety of bonds, and bonds go up. Okay, so what we've been seeing, this is the daily chart going back to 2002. Stocks and bonds down together, up together, down together, up, down, up, down, up, until the last 3 days. Okay, so we're going to focus the next chart on basically the last 3 days. So this is a 15-minute chart going back to the beginning of the year. Okay, we still had stocks and bonds up together, down together. What we're looking for is a big divergence between stocks and bonds. So this is the F fund in yellow. So F fund's going up, stock funds are going up, right? In the last couple days, the F fund is going up and the stock funds are going down. So the question is, does this continue? Does the stocks really tank, and do the bonds really explode higher, right? Because that's what we're kind of hyper-focused on right now, with the expectation that recession is coming and stock prices are going to go lower. Does that mean that bonds, in our case, the F fund, keeps going higher? Because that's really the place that if we're going to make money this year, that's where it's going to be. So what I'm trying to avoid is something like this. Again, it's a 15-minute chart, right? So you need to let it play out. You can't trade 15-minute charts in TSP. But here, stock funds came down, bond funds came up. But it only took, some hours before they went back, and now they're back in tandem again. Okay? So if that happens here, if stock funds come down, it's possible that bonds roll over and we're back in the same trend, right? It's also possible that
it's a true divergence.
Yeah, it could be a true divergence too. Yeah, and so I'm looking for it to play out enough that I'm confident that they're not going to come back together and move in tandem whichever way.
Right, and if going into the F fund was huge gains in a given day, there might be some, but they're not. It's way slower to rise than like the C and the S, right? Right. And so this little blip on the radar has got everybody going, oh, it's divergence. And we pointed it out. I remember us actually talking about it, like, oh, let's see how it plays out. And it went right back into the groove together. So we got to let that play out.
Right. And so what you're comparing it to is the safety of the G fund, right? So can you make enough on if this is an actual divergence and the F fund is going to rocket higher as the stock funds go down? Once you identify that, then great.
I mean, until then, you're going to do better in the G fund, or at least
it's safer. You know what I mean? Yeah. That's the thing.
The risk reward ratio is not in our favor with this. Let that play out a few days and let's see. Yeah. Right.
And again, it's everybody's personal circumstances and risk tolerance, right? I mean, the risk reward to me at this point relative to the G fund isn't really there for the F fund yet.
Yeah, I've seen some people that have split up between F and G.
Yeah.
You know?
No, absolutely. And they made some money this week.
And go for it.
Yeah.
If you feel comfortable with that, that's where you need to be.
Yeah.
That's a way better decision than not making any decision or not knowing which to do.
If you are at that point in your decision process and you've already pushed off the C and the S and all that, you're well ahead of virtually everybody else.
Yeah, and then there's always the other person that's like, oh, you should be in C and S because you're buying cheap right now. Yeah. And I just walk away.
Yeah, I can't even have that conversation.
Can't do it. We're done with that.
All right, TSP funds for the week.
Yay.
So, I do this every week, and people probably roll their eyes at this point if you've been watching this show for a while. But so I always go back because I like to have COVID as the reference. So this is a weekly chart. Each tick of the in this case the S&P 500, the C fund, is 1 week of price movement. The blue 20-week moving average line. Once we got back above it after COVID, every time we came down and tested it, it provided support until January 2022. The market breaks down, and then ever since then, it acts as resistance. Right? We have some overshoots, but at the end of the day, the market has yet to really break out of this downtrend. Okay, so the reason I put this up there as this kind of stack isn't to say that when price gets above that 20-week moving average line, you should get back into the stock funds. What it means is until it gets above that line, the stock market cannot continue higher, right? So, the last couple of weeks, so 3 weeks ago, huge engulfing candle to the downside, and over the past 2 weeks, the market's been, found a little bit of a bottom there at 3,800, and is trying to get back higher. But another huge reversal this week. There's nothing in this chart that implies that the market's going to go higher from here. And in the big scheme of things, we've got this move down, and this looks like an ABC to finish that 2 pattern, and then we go lower from there. I mean, it's just the way the chart looks.
When you zoom in, it's clear to me that it's just a correction.
Yeah.
Right? It's just bouncing along, and given the restrictions of the TSP, we can't play that, right? So we got to let the ball bounce until it decides which way it's going to go, and then we're either in or out, wherever. But when you zoom in, I think you can see it better, because when I look at it like that, it doesn't look as much as a correction. But when I look at it in that one section, so that puts it in perspective. Yeah. Easier for me anyway to say, that's not really a trend up or down. Right, it's just kind of zigzagging along, and I think that's the problem that a lot of people have that try to treat the TSP like a regular stock market investing, where I'm like looking at it daily and going, oh, it's up, I should be in, right? And then tomorrow it's down, I should be out, and that's because it's doing what it's doing in that chart, right? And you've got to wait till it's a nice long trend to really take advantage of it in the TSP. Otherwise, you're in, and then it rolls over, and I hope you got another move. I mean, you can always get out. Yeah. You can always get to G fund, but it's just, is it really worth that stress? Is it really worth that back and forth? I don't think so.
No, it's you want to be on the right side of the trend, and
it's hard to do that when it's a correction.
It's a correction. It's a correction. Corrections are very hard to trade if in a brokerage account, right. Much less in a TSP account. All right, S fund.
Pretty much
same idea, but it's well below its 20-week moving average.
And if you were to kind of zoom in that one little section, it just looks like a nice little correction pattern. Yeah, it's kind of hanging out, waiting to see what we're going to do. And that's, as I look at these, like I always try to remind myself, this is people. Yeah, there's a lot of institutional money in there, but that's still run by people. Yep. And so the market is people, and so I think across the board, you could make a good argument that most people are just in a holding pattern. We're like, we're waiting. And so that's what the market looks like, is like it's waiting to see what happens, right? Yeah, yeah. Big money may make it move a little more than our money. Yeah. Right? Sure. Big money will, institutional money. But at the same point, it's kind of just hanging out.
when you step back and look at it, that's what it looks like, right? When you drill down into it, it's what it is a bunch of FOMO at these bottoms.
Yeah.
Because people are buying the dip, and it comes up, and momentum wanes, and it hits a prior high and rolls back over. And that's where when you step back,
you gotta start here, maybe zoom in, zoom back out. Yeah. When you're looking at a chart, and you'll have a lot better perspective than if you're just looking at one time frame, which most people are. I mean, most of the people that don't follow us or don't follow our kind of methodology, not us in particular, I see it all the time. They're just hyper focused on day or week, but you gotta and then it starts to make a little more sense. And I think you're right, though. It's FOMO half the time. Fear of missing out. I should be in. It's up today. And it's like, man, you can't play the TSP that way.
No.
You just can't. You really can't play any long-term strategy, which would be any retirement account. So if you're trading your 401k or your IRA, sure, you might have a little bit more flexibility than you do in the TSP, but at the end of the day, why would you why not just trade with the big trends?
Right. No, I haven't done a trade in the mutual fund window in months.
Yeah.
And I could do it every day if I wanted to, but no way.
Where are we at with the iFund? Or you got more to talk about, I guess?
No, I mean, just
it's
to
just
say,
about the same. There's no reason to be there.
The technical indicators are all pointing down. The next big level is going to be when
we test that out.
The October low. I mean, most people aren't focused on that in terms of the S fund, because everybody's looking at it in terms of the C fund, and we still have a long ways to go. This is going to freak people out when we get below the December low. And once we get past that,
that's
the October
low.
But in the S fund, we're already there.
Mm-hmm.
I fund, again, had a much better rally than the C and the S. Off that October low, it's since rolled over. Is this going to be support at its 20-week moving average line? I doubt it. It was a heck of a reversal week this week. Barely above 50 on RSI, but RSI is declining, which we don't want to see. Not the time to buy it on a declining RSI. You want to buy it when RSI is coming up through that 50 line, and the MACD is moving up and crossing. You don't want to buy it when it's declining, right? So if I was in the iFund, I would be hoping for support there, and if I didn't get support, I'd be out, and I absolutely would not be buying it there. F fund, we talked about quite a bit. I just wanted to point out one more thing because you can see it better on this chart. Actually, it's probably going to be two things. Here's what I'm looking at. This was the top. Okay. So in terms of Elliott waves, 1, 2, 3, 4, 5. And now we're at a low. Okay, that's one possibility. The other possibility is 1, 2, 3, 4. I just messed that up. The big scheme of things, 1, 2, 3, 4, 5. Okay, so it's one of those two counts. And if the F fund was to get up to this level here and roll back over, that would be consistent with the second count. And I like that better because that gives us a 4, which would be this section, this 4, about the same time frame as this 2. All right, so I kind of like that the best. It doesn't fit really with the macro. Again, this is all going to be part of this kind of special market update thing I'm putting together. But at any rate, the second part of this is this. This is the worst pattern you can have. You got higher highs and lower lows. So you have this expanding triangle. And so the worst thing is when you get up here and you think, all right, I've cleared these highs, so the market's going to keep going higher, only for it to roll over and make new lower lows. This expanding triangle pattern is the worst.
Yeah, it's kind of scary.
And that's where we are right now, which is another reason why I'm not in the F fund, because I don't like the look of it yet.
Questions. Right. If you have any questions, you can send to put them in the comment section wherever you found the video, whether it's on social media or if it's on the website and YouTube's all the things.
All the tubes. Yep.
If you don't find a comment section wherever you see it, then you can always shoot us an email at support@growmytsp.com, and the customer service folks will shoot it over to us.
Absolutely.
Yeah, I think we're going to be talking about the F fund a lot because, that's where a lot of focus is. Tell your friends about the show because, yes, we're biased, but there really isn't anybody out there talking about how this stuff impacts the TSP.
Specifically the TSP.
And how you can, actively manage it with that information, right? Yeah. So tell your friends, share it.
And again, you're right. Don't get too... we talk about the day-to-day minute. Obviously, I put in a couple of 15-minute charts in there.
But it's just to give perspective.
It's perspective.
Yeah, it's not decision-making.
The biggest takeaway at this point from the big charts is there's no reason to expect the stock funds to go higher from here on any substantial way.
Nothing telling us
nothing.
That, right?
And if you get your mind around that, just that, and you go to the G fund and hang out there until this whole thing, you're going to have to pay attention because at some point it's going to bottom and you want to get back into the stock funds at that point. But if you think that you're going to continue to buy these dips, you're making a mistake.
We'll see. Hope you guys had a great weekend, and I hope you have a great week coming up. Let us know if you have any questions.
All right.
We'll see you later.